In the third week of September 1998, William McDonough, president of the Federal Reserve Bank of New York, convened an emergency meeting at the Fed's headquarters on Liberty Street. He had called in the chief executives of the most powerful banks in America: Goldman Sachs, JPMorgan, Morgan Stanley, Salomon Brothers, Merrill Lynch, and others. He told them that a hedge fund called Long-Term Capital Management was on the verge of collapse, and that if it collapsed in an uncontrolled way, if its positions were liquidated into illiquid markets, the losses would cascade through every major financial institution in the world. One of the people present at that meeting later recalled McDonough's message in these words: "You have to do something about it, because this is going to collapse in a matter of days, and every stock market in the world is going to close." Long-term capital management was not a bank. It was not a government. It was a hedge fund, a private investment partnership with fewer than 200 employees, based in Greenwich, Connecticut. Its founders included the most celebrated bond trader of his generation, a former vice chairman of the Federal Reserve Board, and two economists who had won the Nobel Prize in economics the previous year for their work on derivatives pricing. In 1998, that hedge fund had $4.7 billion in equity, $125 billion in assets, a leverage ratio of approximately 25-to-1, and more than $1 trillion in notional derivative positions scattered across markets in dozens of countries. And in the space of 4 months, it lost $4.6 billion. This is the story of what happens when the smartest people in the room are certain they have eliminated risk, and the world reminds them that they haven't. John Meriwether ran the bond arbitrage desk at Salomon Brothers through the 1980s. By most accounts, the desk was generating between 80 and 100% of Salomon's total global earnings from the late 1980s. Meriwether had assembled a team of MIT-trained mathematicians and finance academics, people who believed that with sufficient data and sophisticated enough models, you could identify mispricings in fixed-income markets and profit from them consistently. In 1991, Meriwether resigned from Salomon amid a treasury bond scandal. One of his traders had submitted false bids at government auctions. He was not personally implicated, but the association ended his career at the bank. In 1994, he founded Long-Term Capital Management, recruiting many of his Salomon colleagues and adding an extraordinary roster of academic talent. The centerpiece of LTCM's intellectual firepower were Myron Scholes and Robert Merton. Scholes and Fisher Black had developed the Black-Scholes model in the early 1970s, a mathematical formula for pricing options that would become the foundation of modern derivatives markets. Merton had extended and generalized the work. In October 1997, Scholes and Merton were awarded the Nobel Prize in economics for their contributions. Robert Merton's Nobel lecture was delivered less than 14 months before LTCM's collapse. Also on the team, David Mullins, the former vice chairman of the Federal Reserve, a man whose institutional knowledge of central bank behavior and sovereign debt markets was as valuable as any mathematical model. The strategy at LTCM was, at its core, simple to describe. The fund looked for pairs of securities that should, in theory, be priced almost identically, but were trading at slightly different levels. It would buy the cheaper one and sell the more expensive one, betting that the prices would converge over time. This is called convergence trading, or fixed income arbitrage. In the first 3 years, the strategy worked spectacularly. LTCM returned approximately 21% after fees in its first year, 43% in its second, and 41% in its third. By the end of 1997, the fund had approximately $7 billion under management. Meriwether, convinced that the fund had grown too large for the number of attractive trades available, returned $2.7 billion of capital to investors. The fund entered 1998 with about $4.8 billion in equity. It seemed, at that moment, like the most successful hedge fund in history. The models had worked. The arbitrage had converged. The academics had been right. To understand why LTCM collapsed, you need to understand two things: leverage and what the Black-Scholes model assumed. On leverage first, LTCM's trades were, individually, very low margin. A typical convergence trade might generate a fraction of a percent in profit when prices converged. To make those fractions meaningful, to generate the returns that investors expected, the fund had to deploy enormous capital. It borrowed massively, taking positions that were 25 times larger than its actual equity base. 25-to-1 leverage means that a 4% decline in the value of your positions wipes out your entire capital. On the model's assumptions, the Black-Scholes framework and LTCM's extensions of it rested on a crucial assumption that markets are liquid, that prices move continuously, and that extreme events, very large moves happening very suddenly, are extraordinarily rare. The models assigned very low probabilities to the kind of market dislocation in which many different assets move sharply in the same direction at the same time. The summer of 1998 produced exactly that kind of event. On August 17, Russia announced that it was defaulting on its domestic government debt and devaluing the ruble. The default was not, in itself, large enough to threaten global markets, but it triggered a flight to safety. Investors across the world simultaneously sold everything that seemed risky and bought the safest instruments they could find, primarily U.S. Treasury bonds. In doing so, they all moved in the same direction at the same time. LTCM's trades were built on the assumption that the spread between risky and safe assets would narrow. Instead, the spread exploded. Every position the fund held moved against it simultaneously. The convergence that the models said would happen in markets as different as Danish mortgage bonds, Italian government debt, and U.S. equity volatility simply stopped. The correlations that the models assumed were independent turned out, in a crisis, to be highly correlated. Everything went wrong at once. By the end of August 1998, LTCM had lost 44% of its equity for the year. It had lost nearly $2 billion in a single month. The losses continued through September. LTCM's equity fell from $4.8 billion at the start of 1998 to $550 million. By late September, a decline of nearly 90%. But the positions had not shrunk proportionally. The fund still had approximately $100 billion in assets and over $1 trillion in derivative exposure. Its leverage had ballooned to over 100 to 1. The fund tried to raise capital. It sent letters to investors describing the losses and offering new shares at what it described as attractive terms. Meriwether personally approached George Soros and other large investors. No one was willing to invest into a fund that was losing money this fast. On September 23, an investment group led by Warren Buffett with AIG and Goldman Sachs made a formal offer. They would pay $250 million to buy out LTCM's partners, the same people who had been worth $1.9 billion collectively at the start of the year, and inject $3.75 billion to recapitalize the fund, which would then be run as part of Goldman's proprietary trading operation. Buffett gave Meriwether a deadline, except by 12:30 that afternoon. LTCM's lawyers could not resolve the legal complications of the transaction in the time available. The deadline passed. The offer lapsed. That afternoon, McDonough convened the Liberty Street meeting. Within hours, the 14 largest banks, who were themselves heavily exposed to LTCM as counterparties, agreed to a collective rescue. Each contributed according to the size of their exposure. The total was $3.6 billion. LTCM would continue to operate under oversight, unwind its positions in an orderly way, and eventually be dissolved. No taxpayer money was used. But the Federal Reserve had coordinated a private sector rescue because it believed correctly that the alternative was a systemic crisis. By early 2000, LTCM had exited nearly all of its positions. The bailout banks eventually recovered their investment. The partners lost almost everything. Meriwether's personal stake, worth over $150 million at the start of 1998, was nearly worthless. The LTCM crisis produced real reform. The Basel Committee on Banking Supervision updated its standards for bank exposure to hedge funds. Regulators began paying more attention to leverage ratios and to the risk that highly correlated positions across many institutions could amplify rather than diversify market stress. The concept of systemic risk, the idea that the failure of one institution could cascade into the failure of many, entered mainstream regulatory thinking. But the deeper lesson, the one that really mattered, was not adequately absorbed. LTCM's failure demonstrated three things that remained true a decade later, when the 2008 financial crisis arrived. First, leverage transforms manageable losses into existential ones. A position that loses 4% is recoverable. A position that is leveraged 25 to 1, that loses 4%, has wiped out all of the equity. LTCM's leverage was extreme, but the leverage embedded in the major banks in 2007 and 2008 was also extreme, and for the same reason. In calm markets, leverage magnifies returns. It is only in turbulent markets that it magnifies destruction. Second, models built on historical data cannot price events that have never happened. LTCM's models assigned very low probability to a simultaneous flight to safety across all asset classes. This had not happened before in the historical window the models used. But absence of evidence is not evidence of absence. When the Russian default triggered exactly that event, the models had no adequate response. Third, in a crisis, correlations go to 1. Assets that behave independently in normal markets tend to move together in a crisis because in a crisis, everyone is selling simultaneously. LTCM's diversification across different markets, different countries, different instruments gave the appearance of risk reduction. In the summer of 1998, that diversification evaporated. Every position moved in the wrong direction at once. These 3 lessons were identified clearly and publicly in the aftermath of the LTCM collapse. They were analyzed in central bank reports, academic papers, and regulatory consultations. 10 years later, the banks that had participated in the LTCM bailout had, in various ways, recreated the same conditions on a vastly larger scale, and the Fed was forced to coordinate a rescue that dwarfed anything that had happened in 1998. The most intellectually formidable hedge fund ever built, staffed by Nobel laureates, former central bank officials, and the most sophisticated quantitative traders of their generation, had demonstrated that mathematical models cannot account for the one variable that markets always eventually produce. The thing that has never happened before. $4.6 billion lost in 4 months. $1 trillion in derivative positions that nearly had to be liquidated into frozen markets. 2 Nobel Prizes. And the lesson that nobody quite learned in time. That's where the money really went. This was Dark Ledger. Subscribe if you want to know where else the money really went.